สวัสดีค่ะก็ได้เวลาการนำเสนอข้อมูลของบริษัท P-Share Shipping นะคะ PSL สำหรับไตรมาส1 2021 นี้โดยคุณคาริด ฮาชิมกรรมการผู้จัดการจะนำเสนอข้อมูลในเรื่องของภาพรวมของอุตสาหกรรมและส่วนคุณก่อตั้มคูรณากรรมการทางด้านการเงินก็จะนำเสนอข้อมูลในเรื่องของตัวเลขทางการเงินและผลการดำเนินงานในไตรมาสที่ผ่านมาในช่วงสุดท้ายในเรื่องของคำถามคำตอบถ้านักลงทุนมีคำถามใดก็สามารถคีย์เข้ามาส่งคำถามเข้ามาตามระบบของตลาดหลักทรัพย์ได้เลยนะคะเราจะตอบคำถามในช่วงท้ายซึ่งตอนนี้ขอเชิญคุณคาริดนำเสนอข้อมูลได้เลยค่ะ
สวัสดีครับ So I'll start the presentation on the industry structure, and as you can see on the screen, the first slide that you have is the Baltic Dry Index, and it shows you how the index has performed, and you can see that the trend line of all the tops makes a very good straight presentation like this. And you can see that on the 5th of May, the BDI reached the highest point for this year, 3,266 points. Today, or as of yesterday, it was at 2,856 points. So if you look at the same index, but look at it versus the 2016 year, 2019 year, 2020 year, and up to the 17th of May 2021, you can see that this year has been far stronger than any of the years that we have selected in the past. 16 was the worst year ever, 19 was just before COVID-19, and then there was 2020. So you can see that this year is a much stronger year. If you look at China, it's an important country. It's responsible for almost 55% of all dry bulk movements. So if you look at it from this point of view and look at iron ore, imports in the first quarter were up by 7.6%. Coal was down by 29%. Steel production was up by 15%. Steel inventory was down by 13%. Steel imports were up by 15.6%. And steel exports were up by 24%. And steel consumption was up by 15% in China. So you can see China had a very strong first quarter. These are the cargoes that we carry. The cement cargoes look extraordinarily large for the simple reason we've got 4 dedicated cement ships which are on long-term charter to one of our clients. So if you ignore this one and look at the others, you can see that we carry a lot of agricultural products, including grains. We carry a lot of ores and concentrates, excluding iron ore. We carry a lot of steel, a lot of coal, a lot of fertilizers, and then we have a list of smaller different types of cargoes that we carry. This gives you on the third last row, you can look here at what has been the change in trade in terms of ton-mile demand, in terms of billion ton-mile demands. And you can see that it's been growing at a varied rate at the low of about 0.5% for 19 and 20, and on a high of about 4.75% in 2017. And the forecast for 2021 is 3.4% and 2.6% for 2022. Now, at the same time, you can also look at the change in dry bulk fleet as in terms of the net increase in supply. And you can see that's been varying between a low of 2.4% and a high of 3.9%. And this year is expected to be 2.6% according to Clarkson's, and in 2022 at 0.9%. So if you look at the next slide and see what's happened to the minor bulk growth. And if you look at minor bulk growth, one second, let me just get that. Look at minor bulk growth, you can see that minor bulk growth has been growing at a low of 0.94% in 2020 and a high of almost 5.05% in 2017. And this year it's expected to grow by 4% and next year 3.63%. And if you look at the change, net change in the supply side of the smaller ships or the geared ships, which is where pressure shipping operates, you can see that it was at a low point. It will be at a low point of 1.55% for this year and next year at 0.84%, but it has been as high as 4.57% in 2019. If you look at what are the changes in the supply side that's taking place in the first quarter, you can see scrapping has come down. It was 4.77 million deadweight tons in 2020 first quarter. It's come down to 3.81 million deadweight tons in first quarter 2021. But the interesting thing to note is that the geared ships, that is the sector that PSL operates in, the scrapping has gone up by 27% in the first quarter. If you look at the balance orders still to come, starting out on the 1st of April, that is at the end of quarter one, you can see that the total order book is at 15.89 million deadweight tons of ships, or 5.57% of the existing supply side. If you look at it in the geared sector alone, the total amount which is still to come is 15.23 million deadweight tons, or roughly 4.71% of the existing supply at the end of first quarter. And if you look at the gearless ships or the bigger ships, you can see it's 35.66 million deadweight tons, or 6.03% of the existing supply. So whether you take this number, or you take this number, or you take this number, all these numbers are actually at 25-year low points. This is what happened in quarter one. You can see that we added net 7.53 million deadweight tons of ships, of which you can see in the smaller size, very little was added, and the larger size was where the bulk of it was added. Almost 6% was added over here, and just about 1.5% was added here. And that worked out to 0.83% as a net change. If you look at the order book in terms of the existing supply and the old age ships in the fleet, then this is what you see. You see that the existing supply is at the end of quarter one is about 915 million deadweight tons of ships. The total order book is at 50.89 million tons, or roughly 5.56%. And the existing 20-year-old or older ships are at 6.39%, so higher than what is expected to come all the way to 2023. But if you take the 20-year-olds up to 2023, then you see that that is 12.4%. So you can see clearly that these new ships will be challenged by these older ships, and the older ships might head towards the recycling yards, and therefore growth, if at all, will be very marginal in the coming years. Similarly, you can see the same thing for the handy-size fleet and the Supramax and Ultramax fleet. So handies, what do you see? 110 million deadweight tons of ships at end of quarter one, 3.65 million deadweight tons of ships on the order book, 3.32% of the existing fleet. But the 20-year-olds are already at 13.19%, and like for like is almost 18%. So definitely there will be a shrinkage here. So what will happen to the cargoes that these ships are carrying? They will come all into this sector, into the Supramax sector. So in the Supramax sector, what do you see? 213 million tons of existing ships, order book of 11.6 million deadweight tons, or 5.43% of the existing fleet. And then if you take that and look at the 20-year-olds, it's 8.53%. And if you go up to 2023, 14.51. So again, you can see that there will be minimal growth here, but cargo from here, which will come into this sector, will also increase the demand for these ships. So what is our strategy? Our strategy is to try and lock in ships on a longer term basis once the charter rates increase to a level where we are very comfortable and we can fix them on long-term contracts. We think that will happen towards the end of this year, early next year. This is our forward book. This is what we've already pre-booked. So the numbers here on this line represent the rate per day per ship, which we have booked the ships at. The numbers in the bar chart here underneath represent the total number of days already pre-booked. This represents this line. This line represents the total number of available days, assuming no scrapping of ships and no addition of ships in our fleet. So just the 36 ships. Then this is what you will see. And this represents the percentage of this number that has been already pre-booked. And these numbers give you what is the pre-booked revenue in terms of US dollars in millions of dollars. This is showing you what's happened to the index ship. What did they, and what is our ship average deadweight? What is the index ship average deadweight? What is the index ship speed consumption, what is our average speed consumption, and then we give you the total number of handy-sized ships that we have, and we tell you what was the index number and what was the average of the index rate and what was our rate. So you can see we underperformed by about 28%. Similarly, for the Baltic Supramax Index, you can see the index number average for Q1 was 16,600. Against that, we averaged 12,340, underperformed by about 26%. So what we try to show you here is our historical performance compared to annual indexes. So if you see the annual index, we have performed, and in fact, if I just show you one thing here, if you look at this number and compare it with this number, it shows you that our handy ships are rated at a discount to the index ship of 25%, and Supras, Ultras are at a 10% discount. So keep that in mind. So this is where our real index is for the Supras, Ultras. This is where the real index is for our handy size. So compared to that, this is what we have done. And this is where the index ship is. The index ship is at 0. So our performance relatively compared to the index ship, you can say that on an annual basis, we normally outperform the index. And this is our first quarter results. So in our first quarter results, we were lower than what our actual index should have been in both cases. But if you look at it on a quarter by quarter basis, you can see for 2020 as an example, some quarters we have outperformed the index ships, other quarters we have underperformed the index ship, but overall for the year, we outperformed the index ship. We think that we might be able to come close to our own index numbers during this bull run. Now, what was the reason why we underperformed so badly? There are 4 main reasons. The first reason, of course, is that 10 out of our 30 ships that were trading on the spot market were doing what is known as the low-paying backhaul cargo, taking the ships from the Pacific to the Atlantic. In fact, 2 of those ships are still completing those voyages. This means that a third of our fleet was locked into low-paying rates during quarter 1. And say 2 of our ships now, even in quarter 2, are still locked into those low-paying rates. They're going to be free towards the end of this month, early next month. Now, the Pacific itself in Jan and Feb was very weak, while the Atlantic was strong. So the ships that had already reached the Atlantic started faring well, but the ships that were in the Pacific during Jan and Feb, they fared poorly. Now, you must also keep in mind that to make our ships equal or an apples to apples comparison with the index ship, then our handy fleet must be at a 25% discount. And similarly, our Supras and Ultras should be at a 10% discount. And finally, the 6 ships on long-term contracts are at an average price of $13,600 per day. Therefore, this will be a drag so long as the index ships are trading at a higher price than this, which is the case all during quarter 1 and in April and May of this quarter, second quarter. Now, let's see whether these signs of a recovery are real. So for this, what we have done is we've looked at the average time charter rates for all the 4 sectors for the years 2009, 2016, 2020, and then of course quarter 1 and then April. So here what we've done is that we have selected 2009 because it was a year immediately after the global financial crisis, 2016 because it was the worst year ever in shipping, 2020 because it was the year that was destroyed by COVID-19, and then what's happened in the first quarter and what's happening right now. So here, if you look at it and look at the macro picture, so these are the time charter rates, and you can see that 16 was a horrible year. All sectors actually lost money. 2009 was not a bad year, but if you look at, say, for example, the average in 2021 April as an example, if you look at that average, it is, other than the Capes, which is below the level achieved in 2009, on all other 3 sectors, as you can see, the April numbers were higher. And even if you look at quarter 1 average, more or less, this one was up much higher. The handy size was much higher than the average achieved in 2009. But the others, these other 2, that Supras and Panamaxes, were almost equal to what was there in 2009. The only sector that has not fared as well as 2009 is the Capesize sector. Now let's look at the macro picture, what's happened in this part of the year, in each of these years. So here you can see in 2009, the demand shrank by about 3.4%. At the same time, supply increased by 9.25%. But the Chinese came out with a stimulus plan of $578 billion, which pushed the rates up, especially capes, because it was very steel intensive. But the problem lay here, that at the end of 2009, almost 81% of new ships were on order. Now let's look at 2016. Demand grew by 2.1%, so pretty good compared to 2009. Supply grew by 2.4%, slightly higher than 2.1%, but much lower than what we saw in 2009. And yet we had a bad year. Why? Because there was no stimulus plan from China or anyone else in the world. So stimulus plans make a huge difference. And the other bad thing was, of course, that the order book to fleet ratio at the end of the year was still a high 18%. Now let's look at 2020. Demand grew by 0.5%. Supply grew by 3.84%, so much higher. So we should have had a bad year. But look at the rates that you saw. Pretty good rates if you look at it and compare it to 2016. Much lower than 2019, but pretty good otherwise. And of course, keep in mind that China came out with a $667 billion stimulus plan. This stimulus plan was only announced in the end of May and started having an impact from June onwards, and the impact continues even today. So this makes a big difference. And then the nice, interesting part is that the order book to fleet ratio is at 6.07%, is almost a 25-year low. Now look at 2021. And as I said already, in earnings, we've done really well. So what's happening on the macro picture on demand? Demand, according to Clarksons, is going to grow by about 3.4%. According to DNB markets, DNB is the largest Norwegian, it's a Norwegian bank, it's the largest bank that lends to shipping. So they say that demand will grow by about 6.7%. If you look at the order book, if you look at the net increase expected, according to Clarksons, 2.6%, according to DNB, 1.5%. And if you look at our expectations, it's about 1.9%. So below, in between Clarksons and DNB. And this, if you look at the order book, it's continuing to fall. But the most interesting part is that the rest of the world has put together a $20+ trillion stimulus plan, which consists of both monetary stimulus as well as fiscal stimulus by countries all around the world to combat COVID-19. Now, what's happened in Q1 compared to Q1 last year? So if you look at Q1 this year, these were the average rates for the 4 sectors in shipping, in dry bulk shipping. And if you look at this, it tells you at what percentage they went up compared to last year, to Q1 2020. But Q1 2020 was a low point to compare with because of COVID-19. Now, if you look at April 2021, how was it fared against April 21 last year? Then again, you can see it has fared much, much better than even the average for Q1. And if you look at May so far, what's happened all the way to the 17th of May, you can see that we have fared the best in percentage change terms compared to last May. But as I said, last April and May and last year Q1 may not be good quarters to compare with, for the simple reason that COVID-19 had a major impact then. So if you look at and compare this with the last 10-year average, then what do we see? So this is the 10-year average rates for the first quarter. This is what we fared in Q1. And if you look at that, look at the increase, almost double everywhere that you see. Now, if you look at the April 10-year average, this was what the numbers were. And look at the actual average achieved in April 2021 and look at the percentage change. So you can see the percentage change has increased during April over the last 10 years compared to the average of the first quarter. Why? Because this is not just a restocking game that's been going on, or that replenishment by different countries. This is actual demand coming into the picture and overtaking supply, and therefore you see the numbers going up so sharply. Now, what happened now, since we had so much of good news in Q1 and April and May, we should have expected that the number of ships ordered in million deadweight tons in Q1 2021 would have been very high. but in fact, it's the lowest if you compare with 2019 or 2020. And if you take it as a percentage, the drop between 2021 and 2020 was 19%, and the drop between 2021 and 2019 was 41% down. Despite the fact that the BDI was up by compared to 2020 by 194% and compared to 2019 by 118%. So more than double in this case and almost treble in this case compared to the index level that was there. And despite that, ordering is actually down. So this is a very good piece of news. And if this continues like this, we should have very good earnings for the next 3-4 years. So what are the key takeaways that you should be looking at? First of all, that COVID-19 had a major impact in 2020. Rest of the world was out of synchronization with China. China recovered quickly. The rest of the world still continued with demand destruction till the end of May. After that, everybody picked up. Now, China is ahead of the curve and is already was the only major economy to have actually grown in a positive way last year in 2020. Now, we have to see what happens going forward, but the Chinese government in the first half of, or in the first 4 months of 2020, issued a lot of special COVID bonds, which they used to fund the massive infrastructure spending that they came out with in May. And if you see this number, $667 billion, it is almost 16% more than the $578 billion, which resulted in the BDI going from a low point of 666 points on the 6th of December 2008 to a high of 4,661 points in 2009. And we've already reached 3,000 plus points already, as you can see in the first few months of this year. So there is material improvement in dry bulk demand. And this has happened from June onwards, and we think that this will continue in 2022, 2023 also. BDI has reacted positively to all the fiscal and monetary stimulus and steel-intensive support from the market. Time charter earnings in Q1 2021 were stronger than the last 10-year average Q1 earnings. And despite all this positive news, new ship orders in Q1 are lower than Q1 20 by 19% and lower than Q1 19 by 41%. So what are the impact from COVID if you look at it from cruise lines and car carriers? Cruise lines are still hurting and they're going bankrupt slowly. Car carriers have done reasonably well. In Q1, they lost 285 million by Wallenius Wilhelmsen, which is the largest car carrier in the world. But by Q3, they had turned into a profit of 4 million, and Q4 was a profit of 47 million. So very sharp V-shaped recovery, you could say, in the market for them. In container shipping, the forecast loss at the beginning of the year was $23 billion, but at the end of the year, the forecast was for a $14 to $15 billion net profit. If you look at the actual global container trade, was down by only 1.85% during 2020 compared to 2019. And the main reason for that they made this huge profit was the fact that they are able to control supply. The top 10 players control almost 85-90% of world capacity. And therefore, they removed almost 13% of supply from the market in the middle of the year. And that is what helped them to make a lot of profit. Dry bulk, first half was a disaster because of COVID-19. Rates collapsed. Starting in April, the rates started to improve a little bit, but then the rest of the world went into lockdown, so rates came down. As you can see over here, it went up a little bit around April, then came down because of the rest of the world, then has started to go up, come down because of the third wave in the world, came down a little bit again, and then look at the sharp increase. So you can say from this point, which was a 5-year high at 2,518 points of the BDI on the 4th September 2019, and including COVID-19, it's been like a V-shaped recovery. So it's very clear. Okay. Now, this is what is our forecast for supply for this year. So what's happened in Q1, you can see 18.42 million tons of ships were projected for delivery, but actual delivery is only 11.35 or a slippage of almost 40%. At the same time, there was scrapping of 3.81 million deadweight tons. Now, we have assumed for the whole year 16 million deadweight tons of scrapping. So 3.81 plus 12.19 will make it 16 million tons. And we further assume 20% for slippage, not the 40% that was there in Q1. Now, if we do that and apply it to the balance 3 quarters which is left, then you will see that the net supply growth will be 17.88 million deadweight tons, or roughly 1.97% overall. This is the response by the various governments, and you can see that it has already reached a $20 trillion number, and that compared to world GDP in 2020 was almost 24% of the last year's world GDP number. So we think that this will have a major impact. And don't forget that this does not include here the $2.25 trillion infrastructure stimulus plan that Joe Biden has planned for America. If that comes through, then it'll be even a much higher growth rate for demand. So now I'll leave the rest of the slides to Gautam to take you through the financials.
So thank you. So first an update on our debentures. So we paid back PSL 206A in full. We redeemed the final amount on 23rd April 2021. So that was a full 9 months before the extended maturity date. PSL 211A as well, we've paid a little bit less than 30% of it back, and I expect that we will also pay it back in full much ahead of the extended maturity date, which is in July 2022. So this is our financial profile. So cash and cash equivalents at the end of the first quarter stood at 36 million, more or less the same number as what it was at the end of last year. Total assets were down to 688 million from 712 million. Our net debt was down to 264 million from 281 million. Equity was up to 350 million from 337 million due to the profit that we had this quarter. Our net debt to equity ratio continues to go down. It's now 0.75, and so just if you look back in 2016 and 17, it was as high as 1.09. The number of ships that we have on our fleet remains the same. It's at 36. The Ebitda that we had in the first quarter was the best that we've had in a decade. So that was at 20.1 million. The debt to Ebitda ratio is also much lower. It's 6. The higher earnings, higher Ebitda was, of course, because of higher daily earnings per ship per day, which came in at 12,157 per day. Opex was 4,933, higher than the full year average of 4,705 in 2020. For the quarter, we had a profit of 12.3 million compared to a full year loss of 40.8 million in 2020. Total revenues for the quarter stood at 44.6 million compared to 119.9 million for the full year 2020. This is a breakdown of our operating expenses in Q1 as well as for the full year 2020. So our operating expenses were higher for a couple of reasons. So number one is manning expenses. So crew change continues to be quite difficult because of all the quarantine restrictions that have been imposed by various governments around the world. And so just like the fourth quarter of last year, our manning expenses figure was higher than average, and I expect that as long as these quarantine restrictions are in place, it will continue to be higher. In addition, our insurance premiums were slightly higher, and also our stores spare expenses and repair maintenance expenses were slightly higher. If we go to the next slide. Yeah, so this is our operating expenses. These are our operating expenses compared to the industry. You will see that we are at least about $700 per day lower than the industry average. So every $100 in saving translates to $1 million in profitability. So this is quite significant. Another thing to note is that our crew costs are actually the same, but we are lower on other items. Go to the next one. Yeah. So this is our income statement. So as I said, the total revenues for the first quarter came in much higher than what was in Q4, which was at 34 million. This resulted in a net profit of 12 million, one of the highest profits that we've had in a decade, much higher than the 0.9 million profit in Q4, and of course the reversal on the loss of that we had in Q1 2020. We had an exchange gain of 3.55 million. This was related to the debenture PSL 211A, where we had a cross-currency swap, but that cross-currency swap matured. Our operating profit, excluding the non-recurring items and exchange gain, is 8.87 million, compared to 2.10 million in Q4 2020. The Ebitda came in at 20.11 million, as I mentioned, so much better than the Q4 Ebitda of 13.79 million, and of course much better than the 8.71 million figure in Q1 2020. So I've already gone over, I think, the rest of it. The earnings per share came in at 0.24 baht, so much better than the 0.02 in Q4 2020. Go to the next slide, please. Yeah, okay, so liquidity position. So our cash, as I mentioned, is quite a healthy level. Total current assets reduced because we had a derivative asset related to the cross-currency swap. That swap was unwound, and so therefore that number came down. Ships net came down because of depreciation. Total current liabilities, excluding debt that is due this year, has remained fairly stable. Debentures are down from 126 to 101 million. Long-term loans, there were no new long-term loans this quarter, so that has come down as a result of regular amortization from 207 million to 198 million. Total shareholders' equity has gone up from 337 to 350 million because of the profit. The book value per share has gone up as well from 6.5 to 7.04. Return on equity for the quarter was 10.32 compared to minus 3.67. Go to the next slide. So this slide shows the evolution of our fleet and the size of our fleet and the earnings. And so the top row is the average age, and you will see that from 1995 until about 2011, we had quite an elderly fleet. And since then, we embarked on a fleet renewal program. We took delivery of those new ships. The fleet was at its youngest in 2016, and now it's still at a relatively young 9.5 years. The line below that shows the average size of ships in our fleet. So in the 1990s until 2010, the average size was much smaller. And then we upsized our fleet. We started to acquire Supramaxes, Ultramaxes. And so now the average size of our fleet is 44,000 deadweight. The line below that shows the time charter equivalent earnings per day for the ships on our fleet. And you'll see, so the 7,300 is what it was in 1995. Then we had the Asian financial crisis, and then earnings came down. And then you had the super cycle from sort of 2003 to 2008, and the average earnings were extremely good. And then you had this period of overbuilding, oversupply in the industry. That supply overhang impacted earnings for quite a long period, until at least 2017. And 2017 onwards, we have seen, I would say, a fairly clear trend of increasing earnings, except for the two black swan events which happened, one being COVID, and the other being there was a mining accident in Brazil. So below that is our operating expenses. Operating expenses have remained fairly stable. This shows the debt and debt to equity ratio from 1995 until Q1. When we are making a lot of money, we like to pay down our debt. So that's what we did from 2003 to 2006. We were generating a tremendous amount of cash flow. We paid down the debt to zero. And as I said, we embarked on a program to acquire new ships. So we took on debt for that, and we've been paying down debt since then. So it was sort of peaked in 2016, and now it's at 300. This shows our debt to Ebitda ratio over time. And so this ratio is a function of vessel age as well as the fleet age. And so that's why you'll see that when we had an older fleet, that ratio was tending to be lower. When we came to zero debt, of course, it came to zero. When we had newer ships, we had more debt, and so that ratio was higher. But now we've paid down a fair amount of debt, and so therefore that ratio is much lower, and I expect it will continue to go down further later. This shows our cash operating profit over time. You'll see that there's very few points in our history when the cash operating profit is below zero. Yeah, I'm going to go pretty quickly because I think we have quite a few questions. Okay, so this shows again our net profit over time. We had the super cycle years from 2003 to 2008, and yeah, then we had many years of there was oversupply in the industry, and therefore earnings were impacted. We have a policy of paying not less than 25% of our net profit as dividends. We haven't paid dividends since 2014 because of the state of the industry. The industry is, of course, in a much better state now, and it is our endeavor to start paying dividends as soon as practicable. This graph shows the total return to shareholders from our IPO in 1993 until today. If you were an investor in our IPO in 1993, you would have got over 17.5 times your money back. So it's been quite a good return for investors. We're now open for questions.
Okay, so the questions which are there on the net, will we be able to see time charter equivalent exceed $30,000 this year? I mean, these are all forward-looking statements, so they're very difficult for us to answer such questions because we don't give forward-looking predictions on the PSL fleet. The second question is, please explain about IMO EEXI. What will be the effect to the shipping industry? Okay, so just try to think of this rule which is going to come out, or this law that is going to come out by IMO on the 1st January 2023 as something that would require your ship to burn less oil for every ton-mile of cargo that it carried. Now, what they will do is they will compare all existing ships with brand new ships, which are of course designed to better standards, and then they will tell you to match them in the with the older ships. So what will happen is that the older ships will be forced to go much slower than the clients may want, and at some point in time the economics would not work out for the client even if the ship was for free to carry their cargo, and therefore many of these older ships will be sold for scrap. The third question is, does the trade tension between Australia and China affect the shipping industry? Will Handysize and Supermax ships benefit from this situation? Yes, we've already benefited from that situation. This situation started out in the middle of last year when China started to unofficially and officially sanction many cargoes from Australia. And as a result of that, China has been securing those same cargoes from very much further distances, whilst Australia has been exporting those very same cargoes which they were sending to China to other countries which are again at a much longer distance. So ton-mile has gone up, therefore effectively demand has gone up because of that. And the main beneficiaries of this have been so far the smaller ships. The fourth question is whether high scrap prices affect in increasing scrapping rate. How much? Yes, scrapping rates have gone up. As I said in the slide presentation, that between Q1 last year and Q1 this year, the scrapping rate for our size and type of ships has gone up by 27%. Then, if you look at the sixth question, please paint the picture of Opex decrease plan in 2020. We don't have a plan to decrease Opex. It's going to remain at this higher level for the simple reason that we are having an issue with changing crew on ships. We are not able to fly them back from anywhere else. Question 7, what is the proportion of PSL's business based on US and China? We don't calculate such numbers and we don't have any such records, and we've shown you what type of cargoes we carry. The commodity price keeps falling. How will this affect the company's earnings? How to reduce the impact? We can't do anything about commodity prices, whether they increase or decrease. If they increase, it means that generally speaking, there's more demand for commodities and therefore more commodities move on ships and good for us. Please provide a plan and strategy for reducing long-term debt.
So debt.
Yeah, Gautam, please.
Yeah, I would say that we don't really want to reduce our debt very much. We're at a comfortable level. If we reduce it, it's a good thing. I think the more important thing is to stretch out the maturities of our debt, which is the plan would be to raise new facilities that are much longer term, which would lower our cash break even.
So next question also, Gautam, are there any plans to pay dividends this year or not?
I can't really comment on that. That is the decision of the board, but yeah.
11th question, do you plan to buy new ships in 3 to 5 years time? Yes, absolutely. After about 3 to 5 years, when the next cycle dips and the values of ships come down, that's the time when we will look at it. Plus, we'll also be looking at ships that are got a much lower carbon footprint than what are there in existence today. Then 12th question, how long is the lifetime of a ship? Today, the lifetime of a ship is about 20-25 years, but in the future, this might come down if it is an internal combustion engine ship. And that is one of the reasons why the forward order book is falling at a time when rates are rising. How is the average age of PSL ships by Handysize Super? We are younger than the average age of the world fleet. You could have seen that on the chart. Our average age is 9.5, whilst the average age of the fleet at the end of Q1 was 12.5 for the smaller size and 11 for the Supermax and Ultramax sector. In Q2, for the past 2 months, TC rate of PSL higher or lower than industry? What is the outlook of TC rate? We don't give forward-looking statements about ourselves, but we can say that yes, certainly rates are higher for the industry ships or the index ship, and we've shown you what those numbers are. What do the executives think about from now on will be super cycle or dry bulk? Many people are saying this. We are not sure whether it's correct or not, but yes, it certainly is there. It's appearing like that. Third, the next set of questions. Do you think this is super cycle like 2008? It gives us the impression that it is appearing something like that by the rates that we see. Why in Q1 Capesize rate is significantly below smaller ships? Because not enough iron ore was moving. They are dependent on just iron ore and coal, mainly iron ore, and that's why. Why is operating expense in Q1 so high? As we explained, it's because of the inability to change officers and crew on our ships in a normal way because of the COVID-19 situation. From the presentation on page 18, it means that the company will lose the opportunity to make a profit. Therefore, I would like to know that if the problem is gone, is it an upside for the next quarter? Yes, you're referring to the 4 main reasons why we did not fare as well as the index ships in Q1. And we explained that because some 10 of our ships, 10 out of 30 ships, 1/3 of our fleet on the spot market was traveling from the poor area to a rich area, and therefore you have to take it at a very low rate. And 2 of those ships are still stuck in that business. And therefore, once the balance 8 are out, they're doing well. Now, once these 2 are also out, they will also start to do well. Freight rates in Q3 and Q4 compared to Q2, whether it be high. So I think the normal tradition is Q1 is weak. Q2 is stronger than Q1. Q3 is weaker than Q2, and Q4 is the strongest. This year, so far, we've seen Q1 is very strong. Q2 is definitely looking stronger than Q1, and that also we have shown you. So it appears that this year may not follow a normal pattern. It might be just strength to strength. But again, it's something we don't know, and we'll have to see. Another set of questions. Industry outlook for first half 21 will be better year on year from, yeah, of course, certainly it's better than year on year. We've already shown you on Q1. So on Q2, we'll show you once we get the results. Outlook for half 2 21 will be better than half 1 21? Appears so, but we don't know. And it will certainly benefit the company. How about the industry outlook and business in Q2? Will the company performance be better than quarter on quarter and year on year? We don't comment on these forward-looking statements. Freight rate outlook, will it continue to increase in Q2, Q3, Q4 this year? Again, as I said, generally speaking, Q2 is stronger than Q1, Q3 is weaker than Q2, and Q4 is the strongest quarter. We don't know whether the year will follow a normal seasonal pattern. How to reduce the discount gap? Again, you cannot change the, say like we got an average size of 30,000 for our handy size ships. The index ship is at 38,000. How do you reduce that gap? You cannot. It's physically impossible. So yes, so we will be always at a discount to the index ship. For long-term contracts, please provide some rationale despite know that demand will grow faster until at least 20. Yes, so it depends on what rates we are able to get. I'll just give you one example which has happened already and it's in the public domain. A Cape-size ship was offered $20,000 per day for 2 years, but was offered by the same client $31,000 a day for 1 year. The client took the $31,000 a day because that was far better for them. Practice to recycle ships is after 20 years. Is this required by law? No, there are no laws for that. What are the suggestions for top 3 factors to look at for demand for dry bulk? Just look and see that China is growing and the rest of the world is growing. As long as there's more stimulus put into the picture, more growth will be there. And especially if America goes in for the infrastructure plan. Will dry bulk benefit from spillover from high cost of container ships? Yes, many container cargoes are coming back to dry bulk. Are there cases when clients choose smaller ships when Cape size is much more expensive? Yeah, of course, we can try. We are seeing some iron ore cargoes moving in our ships because Cape size rates have gone up. So normally we don't carry iron ore, but we're seeing that also is coming to our sector. What are the general? Okay. Do you think this is super cycle? It feels like that. How are you looking at the future trend of freight market? For the next 3-4 years, it looks like it's going to be strong. How is your opinion about this super cycle of industry as many analysts expected? Again, we think that it feels like that. It feels like what we felt in 2003, 2004. What is the expectation in terms of demand? We expect demand to keep growing because of the stimulus plans put in place by the rest of the world. Could you please elaborate how COVID-19 crew changes and how much is it related to selection of the optimal shipping route? Again, very difficult to answer this. Most countries don't allow your officers and crew to get off and fly back to their country of origin. So we have officers and crew only from Thailand and only a little small part from India. So to get the officers and crew to fly back and forth between Thailand and the rest of the world and India and the rest of the world is almost impossible today. So what we normally do is to try and deviate the ship and bring it close to the Thai ports and then change the officer and crew. I think that's the end of the question. There are no further questions.
ค่ะก็เวลาก็หมดลงแล้วก็ขอบคุณนักลงทุนทุกท่านที่เข้ามาร่วมประชุมในวันนี้ขอบคุณค่ะ
Thank you very much สวัสดีครับ